All right, folks, Nate Davis, Florida Mortgage Firm. So we've had a substantial amount of consumers, friends, family, realtor partners, industry partners. Everybody's trying to get our take on what's going on with this new loan program. The news is out there. They got all kinds of things regarding what it means for good credit borrowers to buy a home versus low credit borrowers to buy a home, who's getting charged more, who's getting charged less. And there's a substantial amount of confusion out there, to be quite honest with you. There's also a lot of misinformation out there. Additionally, the media is also doing their best to spin stories one way or the other. So what I'd like to do is just take some time today and do the best that I can explaining to you in the most easiest terms to digest how this all works. I'll be the first to tell you that lending and pricing and this information, it's not the easiest to digest. It is kind of complex in many facets. So please bear with me. I'm going to try to give you everything I can to make sure we dispel the rumors, the myths, etc. So let's just start with a few overall statements to make sure we just clear the air black and white. Number one, it is not more expensive for someone with good credit to buy a home than someone with lesser credit. It is simply incorrect. That is not the case. Number two, whenever it comes to these pricing changes that everyone's referring to, they do take effect with Fannie Mae on May 5th. However, these changes have already been in place and already been priced into loans well before that. You see, lenders basically make loans and you go through underwriting processes, and then after the loan is completely approved and funded, later on they will then issue that loan for insurance through Fannie Mae. Well, that date is May 5th, but they had to already implement these changes for all the loans that were in process before. So it's not like on May 5th you're going to call and get a different rate than you did before. These changes in pricing has already been in place, so I do not foresee this to be any massive change to the real estate market at all. In fact, a lot of the pricing changes are very subtle. Now, please know that there are some issues and some very real concerns about what's transpired here, but they're not for the same reasons that maybe the media would have you believe, okay? So another thing I also want to point out that might be confusing to the public is what the word discount means. As a consumer my whole life, whenever someone said, hey, you're going to get a discount, that meant I was going to get it cheaper. When we're talking in terms of mortgages, people will actually pay a discount fee. So it does allow you to get your interest rate cheaper than you otherwise would have received, but it is an actual cost. So in some of these headlines I see it says, you know what, these guys are getting bigger discounts than these guys. Well, that's kind of confusing because a greater discount in the world of lending means more cost, not less cost. Okay? So a few things I wanted to point out before we get started. Now, for me to be able to do a good job of explaining what the intricate details of all these changes happen, I kind of need to give you a big bird's eye view of how this works. And what I want to do, let me put down my pointer there. Okay, so what I want to do is this, is understand when it comes to mortgages, you have two completely different categories. You have interest rates over here, and then you have cost or pricing to interest rates over here. I want you to envision them to be completely separate. What I mean by that is interest rates always exist. So for example, a 30-year fixed rate at 4%, for example. Right now you'd say, Nate, we haven't seen that in forever. That rate actually still exists. It's just that the price you pay, the cost, the amount of money that you have to pay a lender to get that rate would be so exorbitant, you would never say, I want that. You'd say this is a terrible mathematical decision, and I would agree with you. So whenever costs associated with interest rates get to be too great, what do lenders and companies do? Well, then they will start advertising a higher rate, okay? And then as the costs build up for that higher rate, maybe they have to advertise a higher rate. Or if costs start coming down, you then start advertising a lower rate. But the rates are always there. There's still a 3% rate. There's still a 4% rate. There's still a 5% rate. These rates still exist. So the changes that happened, they refer to them as LLPAs. That stands for Loan Level Pricing Adjustments. And what occurs is this. If you think about mortgages, I like to associate it or parallel with it to, it's really like a big insurance program. So the higher the risk of that loan, the more money it will probably cost you. Just like a 16-year-old driver probably pays more money for car insurance than someone who's a more mature driver without accidents and tickets because they have a greater propensity from having to have an accident. Well, the same thing goes with lending. If someone has really low credit and a really low down payment, that's a much more risky loan to make than if someone that has really, really good credit and a really, really big down payment. So what happens is both of those consumers, the person with great credit and a big down payment and the person with lower credit and a low down payment, they can both still get the exact same interest rate. But it's going to cost a person with lower credit and a lower down payment a lot more money than it would have cost a person with great credit and a big down payment. So again, the rates are available to everybody. The cost is what we're talking about. So when we refer to loan level pricing adjustments, these things have always been around, and it basically operates off the premise of this. Higher credit scores, bigger down payment equals less pricing hits, meaning less cost. Lower credit scores or lower down payment, more expensive. And it kind of makes sense because that's how the loss ratio data reflects. Okay, so I'm going to show you two grids now that we'll try to show you like a visual of how this works. So the first grid I want to show you is this. Now, I'm fully aware, obviously, all these little blank squares are not filled in because it would be too hard to visualize if we did. But essentially the way that pricing adjustments work in lending is we have loan to value ranges, okay? That means if I'm buying a home, what is my loan compared to my value? So if I was buying a home putting down 20%, my loan to value is 80%. If I was putting down 5%, my loan to value is now 95%. But you can see in these categories here, it has these buckets that typically range in about 5% increments, okay? So across top, you have loan to value ranges. Down on the side, you have credit score ranges, and these are the credit score buckets that pricing and lending typically works from. So your lowest bucket is 620 to 639, and your highest bucket of credit scores is 740 or greater. And for that reason, we used to tell people, listen, if you have a 740 or an 800, you're already in the best tier that you can be for credit, and there's no difference in the rate someone gets if they have an 800 score versus a 740 score because these hits are already accounted for. You're already in the best tier you can be in. So all that happens is when someone's getting a loan and say to buy a home, we take their down payment and figure out where that puts them here. So if you're 5% down, you're going to be in this category. And then we look at your credit score, and then we just kind of marry the two. We kind of just go in there like that, right? So before, if someone is putting down 5% on a home, which would put them in this category here, and they had a 740 or better credit score, the pricing hit would be 0.25%. And what that essentially means is if someone that had a 740 credit score, and let's say they were putting down more than 40%, they'd be in this bucket. And they don't have a pricing hit there, right? But if they want to get the same rate as this guy, but they were putting down 5% down payment, they would just need to pay 1/4% of the loan amount, and they would still get the exact same rate. Okay, so the more these numbers are, the greater these numbers are, the more money someone would have to pay to get the exact same rate that they would otherwise qualify for. Okay, so now let's shift over here to this new graph. And a couple things you're going to notice, and we've highlighted these in blue, is you'll see some new categories for loan to value. So they kind of now have some ones that go down from 60% to 30% and then 30% or less. But most importantly, in my opinion, are these two categories. Before, the best credit tier bucket you can be in was 740 or better. But now they made two more, okay? So the thing to point out is this. If someone has a 780 credit score and they're putting down 20%, the pricing hit would be 0.375. Okay, now whereas before, let's go back over here, they would be in this bucket because there's not a 780 bucket, they just get the top one, and the pricing hit would be 0.5. That means that if you have 780 credit or better, that loan scenario I just shared with you is actually less expensive now than it was before. And this is where it depends on what news channel you want to focus on, because they will actually accentuate that fact. And that is very true. That scenario is less expensive. But let me give you another scenario. Let's take the person that had 740. Someone had a 740 score before, and they were putting down 20%. The pricing hit to that person previously was 0.5%. Now, let's go back over here. The same exact person with 740, putting down 20%, look, it's now 0.875. So that means their cost for that loan increased by 0.375%. I fully understand there's a lot of numbers, but I'm just going to try to equate it to some math for you, real simple. If someone was borrowing $350,000 and they wanted to get the exact same rate as someone before this change, that would be an additional cost to them of $1,312 and some change. That's how much more expensive their closing costs would have gotten if they wanted the exact same rate they would have otherwise qualified before. So in that example, someone with a 740 credit putting down 20%, their costs actually did go up. There's no disputing that. Now, there's also some other changes to these graphs. So let's go over here. Let's take someone that has a 620 credit score previously, and they were putting down, let's say 10%, they would have had a 3.25 hit. This is not your interest rate, guys. This is a hit to the rate. Meaning if this person wanted to get the exact same rate as this person, their closing costs would be more expensive by 3.25% of the loan amount, right? So if this person was borrowing 100 grand and they had $0 in loan hit fees, this person to get the same rate would have to pay $3,250. That's how it was before. Now we go over here, this same exact person with 10% is now actually going to pay less. What before was $3,250 is now $2,625. So this lower end credit with lower down payment, it actually got less expensive. Okay? Now, to me, when you look at all this, is that a good thing? Well, if people are paying less money for loans, in general, that's a good thing, provided that we're not just shifting the burden around. Okay? So what people's issue with this whole scenario is that there is a fear that the decision-making process on where you give rate credits or rate increases or adjustments historically has always been based off of losses in performance of loans. People who tend to pay their loans back very well would get better rates. People who don't would have higher rates in those scenarios. And the perception is some of this decision-making that happened was not based on the fundamentals of insurance and risk. It was more based on things outside of that, which is the concern. So I don't see these changes being significant to the real estate market. I don't see people saying, wow, these loans are now no good or I don't want them anymore. I don't see that at all. I'm confident in that because it's already been the case. However, the fear is that, is this opening up a Pandora's box to potential future changes that aren't based on the sound fundamentals of math and insurance basics that the industry has typically been accustomed to? I know this is a lot of information, and I want you to know if you guys have any questions at all, you can feel free to DM us, reach out. We're more than happy to explain this information to you. To make this just a little bit more digestible, we've also made a calculator to where you can literally go in and type in the purchase price of a home, what your down payment percentage will be, and it will tell you what your cost increased or decreased based upon these changes. You can literally see the mathematical impact of these changes to yourself. With that being said, I also need to explain something else, and that is the way that interest rates work. So whenever you see a loan that has a substantial cost associated with it, what will typically happen is lenders, instead of saying you have all these monies and closing costs due, they will just simply quote you a higher interest rate. And the higher the rates go, the bigger the credits are that can be used to offset costs like these. So don't think if this calculator tells you the fee change was $3 grand, that means when I show up to closing, they're going to charge me $3,000 more out of my pocket. They're not going to do that. You're probably going to end up having a rate adjustment that you would not have otherwise experienced without these changes. So just keep in mind, you have interest rates and you have cost completely separate. But when you go up that rate scale, the higher the rate, the bigger the credit. When your costs increase, they will typically adjust your rate to absorb those costs because most consumers cannot just come up with an extra number of thousands of dollars because of these changes. So while they didn't directly increase rates for some families, they might have. And also some families might also be benefiting from some lower rates, not because they directly get a lower rate, but because their costs are less and therefore they can now receive a lower interest rate than they otherwise would have needed with larger cost. I hope that information helps. And one other thing I want to make sure that the public is completely aware of, and that is this. These changes, this is going on, this is dominating the news cycle, and that's the case, and there's nothing anyone's going to do about that. However, what's more important in these adjustments is the provider that you work with. What happens is when we talk about these adjustments, these hits in pricing, guess what? Different banks, different lenders, different mortgage companies also have their own pricing adjustments. In the wholesale channel, we traditionally have a lower pricing adjustment, and therefore we can give better rates to our customers. So while this is important, what's even more important than these things is the provider that you choose to work with. Because when you work with a low yielding, high volume brokerage such as Florida Mortgage Firm, it's going to save you more than what this little grid here could have otherwise done regardless. I hope that helps. If you have any questions, please feel free to reach out. We'd love to answer any of your questions. Thank you.